Hello everyone, and welcome to another episode of the Daily Gwei Refuel, where I recap the latest news in the Ethereum ecosystem. I'm your host, Anthony Sassano, and today is the 18th of January 2021. Alright everyone, let's recap the news from the weekend. There is a lot to get through today, so I'm just going to jump right into it. So the biggest news, I think, was that Optimism is finally live on the Ethereum mainnet in a soft launch capacity, they're calling it. So, I've been speaking about this for quite a while. Optimism is building optimistic rollups, a layer 2 technology on top of Ethereum. They have been building for quite a while now, and yeah, they launched their soft mainnet. Now, what this means is basically, it's on mainnet, you can use it and all that sort of good stuff, but there's a lot of different kind of defense mechanisms they've put in place for safety reasons. So basically, it's not the full and final and finished product yet, but it is on mainnet. But there are three main defense layers that they've put in place. Basically, it's currently permissioned contract deployment. So it's not, it's not like anyone can just deploy a contract to the Optimism network at this point in time. You basically have to get permission from the team. There's authenticated withdrawals. So basically, they have a check that allows them to investigate pending withdrawals and stop misbehavior before it hits layer 1. So, this means that they can basically, stop a withdrawal from happening altogether if they suspect that it's not a proper withdrawal. And the third one is basically an upgrade key or an admin key that lets them basically control most of the network and what happens on there. Now, as I said, these have been put in for safety reasons, and I'm fully in support of this. Right, this stuff is on mainnet, but it's not ready to host every app out there, sort of thing. But it is ready to host one app, which is Synthetics. So Synthetics staking is now live on the Optimistic Ethereum Layer 2. This is the first app that's live on Optimistic Ethereum. If you have SNX tokens and if you've been staking, you'll know what it kind of feels like, and kind of like how on layer 1 the fees have been very high. So you can now do this using the layer 2 interface, and there's a kind of a whole migration process here, and you can read this post to learn how to do it. There's a new interface you can go to that looks very spiffy. Actually, I really like the look of it. So yeah, you can migrate across here, and there are a bunch of rewards being paid out and things like that as well for doing so in SNX. So yeah, I'm sure if you're an SNX holder, you already saw this, but for anyone who kind of hasn't, yeah, you can go read this. But yeah, this is, I think this marks the dawn, or at least the age of layer 2 on Ethereum. Obviously I've been talking about Loopring a lot, and they've been leading the charge here, definitely. And other teams as well with ZK rollups and other kind of things. But for better or worse, Optimistic Ethereum and Optimism have been hyped more than anything else, I think, and they get more attention than anything else. The Optimism team is full of Ethereum OGs, literally OGs that have been around for a very long time. So obviously a lot of people in the community want to see them succeed, and they've got a lot of popularity because of that. Now they're live. ZK rollups are live with Diversify, Loopring. We had ZK Sync with Curve's testnet. We also have it on Gitcoin. Now we have Optimism live with Optimistic Ethereum, and Synthetics is live on there. So it's all happening, right? And it's only January. This was released on the 16th of January. Today's only the 18th. We're still in the first month of this year. And we haven't seen anything yet, I don't think. I think there's going to be tons more coming here on the layer 2 front. Optimistic Ethereum, I think they hope to get to a full mainnet, not just a soft mainnet by mid-year. And Synthetics obviously wants to be a part of that. I think we're going to see a Uniswap layer 2 on Optimism sooner rather than later. Chainlink, I've spoken about, is also going there. Obviously, you need oracles at layer 2 as well. So yeah, Chainlink is a no-brainer to get up there. DYDX is coming too with their Starkware implementation. Pretty much everyone's going to move to layer 2 at this point. Anyone that requires kind of this massive scale. So yeah, I'm looking forward to that playing out. But if you want to play with it right now, you can. You just have to go to Synthetics, their staking interface, which is found in this blog post here, which I'll link in the YouTube description. Even if you don't have SNX, maybe just buy one so you could kind of play around with it. The gas fees getting onto layer 2 are still kind of expensive, but if you just want to have a play around with it, you can. I think there might be a testnet as well, implementation of this, where you can play around with it for free. But yeah, there's nothing better than just experiencing it yourself. Even if it costs you a little bit of money, you're paying for the experience, I guess you could say. So definitely go check that out. So Ben Edgington, for those who don't know, Ben, he works on Ethereum 2.0 at Consensus on the Teku ETH2 client, or Teku, I think that's how you say it. And he writes the best ETH2 newsletter in the industry. If you want to know what's going on with ETH2, you read this newsletter, and it's available at eth2.news. So basically, I mean, the reason I'm bringing it up now is because he posted the first newsletter of 2021 over the weekend, which has a lot of goodies in it. So as I said, if you want a deep dive on everything that's happening in ETH2, from updates on, I guess, like the Beacon chain, new research, kind of like even things like linking to other people's blog posts and stuff like that, and explaining different things, media. I mean, he's got everything here. It's actually very, very impressive how much he actually manages to come across. I mean, I obviously do the Daily Gwei Refuel, I do the newsletter, I do the ETHUB newsletter, and I still miss things got to do with ETH2. Whereas Ben seems very, very on top of it. He definitely has a secret sauce that he hasn't shared that allows him to stay on top of all these things. But I mean, yeah, I pull a lot of the information that I know and how I keep up to date with ETH2 from this newsletter. It has been my bread and butter for a long time. And if you're interested in keeping up with ETH2, you can go check this out. I don't think you can subscribe to it. I think you can subscribe to it via RSS feed, but not like as a traditional kind of subscription to your email or something like that. But if you follow him on Twitter, you'll see it on there. He's a great follow too, always retweeting and tweeting about ETH2 stuff. So yeah, definitely go check this out if you haven't already. So one of the big things over the weekend was this kind of, I guess you could call it drama, or a bit of a split with the Yearn community over, I guess, developer funding, I guess, is like the umbrella that falls on all these debates. So basically, I'll give a bit of a background of how Yearn kind of has been developing, how they've been paying developers in the past, and how they kind of plan to do it in the future. And I wrote about this more in depth in the Daily Gwei newsletter. You can go check that out, but I'll just give like a summary here. So basically, there's a vault that collects fees that are generated by the Yearn protocol. Now, up to $500,000 of those fees, so it'll fill up to $500,000. That is reserved for the core developers. Now, anything after that traditionally went to people who staked their YFI tokens in the governance contract. So that was, basically dividends, right? So that $500,000 isn't very much. And the thing is that, I mean, that when you think about like the talent that needs to be recruited to work on this kind of protocol stuff, to keep driving new features, to do all the different things, not just developers, but like marketing, business development, all this sort of stuff, right? A senior smart contract engineer can fetch 200,000 plus USD a year. So when you think about it, it wasn't very much for the developers. And on top of that, the core developers don't have any alignment with the YFI token price going up, because they don't have any, right? YFI token was launched in like a quote unquote fair launch way, where there was no developer allocation, there was no pre-mine, no VC stuff, right? But that means that, the people building this stuff don't have the upside. The people who have the upside are the ones who maybe bought a long time ago, right? Or are speculating on the markets, and, the YFI price goes up, it benefits them, but it doesn't actually benefit the core developers at all. So what ended up happening is that there was two separate proposals put out of how to fix this issue. The first proposal was called Buyback and Build. Now, what this proposal said was that they would shut off the kind of staking of YFI within the governance contract, so there would be no more dividends to people staking their YFI tokens, and all the fees generated by the protocol would go towards buying back YFI from the market and paying it out to developers to, I guess, operational expenses, to do better incentive alignment, all that sort of stuff, right? The second proposal was to print an additional 1,000 YFI tokens. So for those who don't know, YFI is capped at a 30,000 token supply. So yeah, the proposal was to print an additional 1,000, which is worth about $38 million at current prices, and keep this as a team allocation, essentially. Now, obviously, the first proposal caused a bit of controversy, but it was, it made sense. The second proposal was the one that caused the most controversy, right? Because for those who have been around the Yearn community, the YFI community, you would know that there was a lot of memes made about the kind of like 30,000 cap, right? And the scarcity memes. And people are saying, if you print more tokens, it kind of breaks that, right? I mean, I don't think so. I don't think something like a YFI token, which is essentially an equity kind of token within the YON protocol, the YON protocol. I don't think that, it's money, it's trying to be a store of value or anything like that. It doesn't need to have some sort of like supply cap, like something like Bitcoin does, for example, right? To attain value. The Bitcoin token doesn't give you the right to fees on the network, right? It's not a proof of stake network. The Bitcoin token basically is just, it doesn't give you any kind of control over it. The miners get the fees, right? The miners get the block rewards. If you hold Bitcoin, what you get is the upside, right, of speculators. You get the upside of the adoption and everything like that. So within the Yearn core developers, they didn't have anything like this, right? They don't have any YFI tokens in a team allocation. And the Yearn protocol is not Bitcoin. It needs to keep evolving. Like Bitcoin, for better or worse, can apparently exist as it is, right, with minimal development. That can't happen with Yearn. Yearn is a DeFi protocol competing with other DeFi protocols. They have a whole ecosystem that they're building. They need to fund development. They need to align incentives, and they need to have a war chest to keep themselves going. And they don't have that because of the way the YFI token was launched, right? So I think, it can still be like, and this goes back to like the concept of a fair launch, where people were saying, a fair launch means that there's no team allocation, no VC allocation, none of that, right? Everyone gets a fair shot at getting the tokens, whether that be via liquidity mining or buying it on the open market or whatever. Now, to an extent, that works, but I don't think you should cut out the developer allocation. I think you should actually give 10 to 15% of the token supply to developers, because without the developers and without the team, I guess not just developers, but like the rest of the core team actually working on this stuff, the protocol is not going to grow, the revenue of the protocol is not going to grow, and your token that you're holding isn't going to go up in value because there's no value being generated. So why would you care that 10% went to the team, right? And say that that's not a fair launch when the team is the one delivering all the value, right? The community counts, it definitely counts, right? But the core team who is actually developing the code, going through the whole process, getting audits, right? Doing the marketing, doing it all in a structured way, right? If they don't get any of the upside, what's the motivation for them to do it? These people are in short supply. A smart contract developer, as I said, makes a lot of money, a senior smart contract developer, and they are very hard to find. I work with a lot of different teams on trying to find people, and it's not easy because smart contract development is a very new field. It requires specialized knowledge across a range of different things. And yeah, just because we're so early, there's not many people that can do it yet. So if you want to retain great talent, you have to pay them. You have to align their incentives. You have to pay them in the token, because if they feel like they are sufficiently incentivized via exposure to the token, then they're going to do everything in their power to make sure that the value of that token increases via the product. So, I personally don't have an issue with them printing these additional tokens. I don't care about scarcity memes. I think it's just like a meme, right? It doesn't really matter long term. The wider market doesn't I'm not going to say it, but doesn't really care. So, I mean, print 1,000 tokens, put it in a vested developer fund, right? Recruit the right talent, add more value to Yearn via that, build better products, and you'll get, a higher price YFI token from that. And then later on, you can probably start paying out dividends again, right? These things are growth, kind of high growth startups. They're not supposed to be paying out dividends from day one, right? Think of all the companies in the traditional world that don't IPO for like many years, and they're not paying out dividends or anything like that. And their investors have to wait a long time to get access to their equity via the public markets. But that's when they've grown to a certain extent. I think within crypto, we do it a lot earlier because issuing a token is so... I guess like issuing a token is very, it's very lucrative, right? And it's very tempting to do that. So people do it. But I think, just because you issue a token doesn't mean you have to put, dividend rights into it straight away. You don't have to put governance rights into it straight away. You can basically just put it out there and say, sometime down the line, this token will have governance rights, it'll have dividends, be able to do this, that, and the other, right? If you're buying it now, it's purely speculative and all that sort of stuff, right? So, I mean, you can say that and people will just speculate on it. I think that's fine. But in general, I mean, I feel quite strongly about this because you cannot build a great product without, having a great core team. And on top of that, a great community. So you need a split of tokens between the team and the community. You can't just have the tokens being 100% community, right? Because then the team is not properly incentivized. A 50-50 split is too much, right? They 50% to the core team means that they have, a pretty big controlling share of the protocol. If you're trying to be a decentralized protocol, that's too much. I don't think, just for a number of reasons, I think that's too much. So 50% off the table there, but 10%, 15% to the core team to keep them aligned, and then getting a wide distribution for governance, and maybe even selling 5% to some investors, right? Some high quality investors who are long term aligned as well, I think is fine. Or even having a bunch of the tokens in a treasury that is governed by the community. That's what we've done at the index co-op, actually. We do have a higher token allocation for the team at 28% for SET and 2% for DeFi Pulse. But 70% was given to the community, with the majority of that, I think 54% in the treasury. So the community can actually choose what happens with that treasury as well. So they can say, where it goes. So it's not just like we're giving all the tokens away to speculators. We're actually paying out the tokens out of that treasury to people adding value to the protocol. So at the end of the day, and I know I've gone on a lot about this, at the end of the day, it's about aligning incentives between everyone. And at the moment, there is no incentive alignment between the Yearn core team and the Yearn community, because the community gets all the upside, right? The team doesn't. The team does all the work and doesn't have incentives in the YFI token. So to summarize, print more YFI. I don't think it's going to crash the price. I don't think it's going to break any of these scarcity memes that everyone loves to go on about. I think Yearn's just going to be just fine. But they'll be able to recruit more talent. They'll have a better long-term kind of war chest to draw from to fund development for a long time. $38 million is a lot of money. And it aligns all the incentives correctly. So that's, I guess, kind of my take on that. I'm curious to hear your takes on it. If you want to comment below about your take, or if you just want to DM me and have a chat about it. I think, once you explain it to people in a certain way, they kind of get it. Because a lot of people kind of see, immediately, oh, wow, they're printing more tokens. It means dilution for holders, everything, my investment's going to go down. But, you got to see the bigger picture and see that your investment is going to go down if the core team leaves. If the team just says, well, screw this, I can go work for another project, they'll give me tokens, I'll have better incentive alignment and better upside there, I'm not going to work on Yearn anymore. Well, if all the developers leave, then Yearn's worthless. The token goes to zero. So your trade-off is print more tokens to fund the developers, right? Enough to fund the ongoing development and to get them to stay and to get them to build this stuff and be incentivized to do it, or don't, right, and have some leave, right? And then the value of the token is probably going to fall because there's not many products coming out, right? There's bad optics, it's all this sort of stuff. So yeah, I mean, I just think that's kind of the way to go, and we'll see what happens. There's a lot of arguments for and against. You can go read the post, which I'll link in the YouTube description. But that's kind of my argument, for why I think that the printing isn't a big deal and actually is a very positive thing. So Charm is live on mainnet now. So Charm is an options protocol. There's a lot of these going live on Ethereum right now. So even though it's live, it's unaudited and experimental. So definitely use caution when using Charm. And if you don't know how to basically buy and sell options, I probably would learn how to do that before you use Charm, because it can be quite complex. But basically, as I said, it's a decentralized options protocol. They're aiming to innovate in a few different ways. I think they're letting anyone create their own kind of options market, with their own strike price and expiration date and all these sorts of stuff. And there's a bunch of different features in here. And it's an AMM model, so the price is purely determined by supply and demand. Options can be sold anytime before expiry. You can short options. Apparently, there's going to be low slippage. So there's a bunch of different features here, which I think is really cool, because I think a lot of the other options protocols don't really give you this flexibility. I know that Open, for example, will issue the options themselves. They won't let you just create your own, I think, on a nice, easy to use front end, which is what Charm seems to be doing. But this does introduce a lot of risk, because you could create any kind of option you wanted. And if you don't know what you're doing, you might get wrecked, or someone else might get wrecked if they don't know what they're doing. So yeah, definitely, learn about options before you attempt this sort of stuff. But yeah, just another options protocol live on mainnet. There's like so many more coming. There's like 10 more of these coming. I'm going to be very curious to see which one actually gains traction and keeps it. Because we've had Hedgic, right? They gained a bit of traction, but I think it's losing traction on liquidity at the moment for one reason or another. So it's going to be interesting to see who wins the kind of options race on Ethereum. So really interesting kind of launch from Curve and Synthetics over the weekend. So there is this thing called cross-asset swaps between Curve and Synthetics that is really great for very, very large orders. So I guess the simplest way I can explain this is that it's Curve on their front end here is routing the trade through Synthetics and Curve. So I mean, I'm not going to try and explain it here because it can be a little bit complicated, but the best TLDR is from Synthetics here in their tweet, where, as I said, this is good for large trades, because it's low slippage on the large trades. But what this lets you do is it lets you go from DAI to REN BTC. But what this does is it lets you it starts with DAI to SUSD, so it does a trade on Curve DAI to SUSD. Then it exchanges SUSD for SBTC using Synthetics. Then it swaps that SBTC into REN BTC using Curve. So you can see how, I mean, if you understand how these protocols work, you can see how it works. But basically, there's a liquidity pool for DAI SUSD on Curve, which is the low slippage pool there for the stablecoin to stablecoin. Then you can take that SUSD from Curve, right, to the Synthetics contracts and use that to trade basically, no slippage for SBTC because they're synthetic assets. Then you take that SBTC back to Curve, which has a pool, a liquidity pool of different Bitcoins or different tokenized Bitcoins, where you can trade the SBTC for REN BTC. So really, you're going from DAI to REN BTC with extremely a low slippage, which isn't possible on other decentralized exchanges. And this, I mean, this is it can't be over this is just mind-blowing, right? This is one of the actual most I guess innovative and exciting features to come out of DeFi, I think, in a very long time. This unlocks so much in terms of like what these large trades can do with little slippage by going and playing with all these DeFi Legos and connecting all these things together to do a direct DAI to REN BTC trade without having to worry about, say a DAI REN BTC liquidity pool on Uniswap, right? You have to worry about how much liquidity is in there. That will determine your slippage. But by doing it like this, you just have to worry about how much liquidity is in the DAI to SUSD pool, because SUSD to SBTC is, they say it's infinite liquidity. It's not infinite technically, but it's a lot because the system has like billions of dollars backing it in SNX tokens. So, that is incredibly low slippage, or next to no slippage. And then with using Curve's underlying architecture, the swap from SBTC to REN BTC is also incredibly low slippage and incredibly favorable because their Bitcoin pool is quite large, and the way their Curve works is quite good for these trades. So yeah, this is huge. And if you want a more deep dive and technical explanation, there's a really great explanation here from Fubulubu. I think that's how you say his handle here. His actual Twitter name is funny. It's just, I'm just a doggy boy. I've met him in real life before. He's a real guy. He's not just someone's alt account. But yeah, he's great. He's been working with Yearn for quite a while, so he did a really great thread here explaining how this all works step by step. Why this is game changing, why this is amazing. I'll link that in the description. Obviously, I'm not going to read it, but I'll link it in the description and you can go check it out for yourself. And also from Fubulubu, the same kind of thing here. He announced that V2 vaults of Yearn is now live. As I said, he's worked on Yearn for quite a while. He's actually one of the core developers. And they also launched a redesign. You can see here. I think I've loaded it up here. Yeah, so, I mean, the video is here. Sorry, I'll put the volume off there. You can see like they're going for a complete redesign here. The video gets a bit distorted, I guess. I'll link it in the YouTube description for you to check out. But yeah, I kind of like this redesign. I think it works. I think it's more quote unquote normie friendly, right? We need more of that within crypto. We need people that are coming into this space that are new, that don't get all the memes and everything, to just have a familiar interface to what they're used to on maybe one of those fintech apps that they use, like Robinhood or something like that, or Square or whatever. So I think this is great. I mean, the waifu memes are fun for people in crypto, but my mom's not gonna know what a waifu meme is, right? Maybe she wants some yield on her dollars. She's gonna go to Yearn or one of the implementations and see this better branding and feel more comfortable using it. For example, I think a lot of people underestimate how important branding is within this. Like for us who are in the ecosystem, who are like DeFi power users, we don't care too much. We get all the memes, we think it's cool, whatever. But 99.99% of people don't and won't and think it's like a turn. It basically turns them off. So I'm really glad to see this rebrand here. And yeah, as Fubulubu said here, there's a V2 kind of vaults that are now live, which is part of the wider V2 redesign of Yearn, which I am extremely bullish on. And I think there's going to be more coming out about this over the next few weeks. So Matthew Finestone here put out a really interesting tweet today. As I've said before, Matthew works on Loopring. So he's got a lot of context around different Ethereum Layer 2s. And this was actually a thread about, I think, different Layer 2s and like how, and like different chains and how, how they can work and how they can alleviate fees. And Matthew basically says, for an app, the Ethereum Layer 2s are the path of least resistance to scale, right? They have similar superior performance to the alternative Layer 1s that are promising all this scale, and they inherit 100% Ethereum security and ETH and ERC20 collateral value, and a single app-specific L2 is doing similar transactions to something like Avalanche. So, I mean, this is what I've been harping on about too. I wrote a newsletter about this a while ago, and I basically said the exact same thing, where the cost and the friction and the switching costs and all that to move to another chain for an app is way, 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 way higher than it is to move to a Layer 2 on Ethereum, because you just don't have the network effects on these other chains, whereas you retain the network effects of Ethereum by going to a Layer 2. So that's exactly why I'm bullish on Layer 2, because it's just going to be where all the apps go. They're not going to try, I mean, some of them will try and go to other chains, and good luck, but, a lot of the ones that actually can see what's happening here and see why it makes sense to go to a Layer 2 will do, like Synthetics, Uniswap, all those good, all that good stuff. So that's not a knock on any of these other platforms, they can do what they want. I just don't think they're going to get much traction. Like, Ethereum's high gas fees are not going to push apps and users to other chains, because the users follow the apps, right? They don't go to another chain that has no apps on it and say, well, I'll just wait around here to do what I wanted to do. No, they either pay the fees, right? Or they'll wait until the Layer 2 apps come out and then use those Layer 2 apps. Because they just, at the end of the day, most users aren't going to care what technology is under the hood for them. The people who care are like, us in the ecosystem, us who actually believe in the Ethereum mission, want to keep this as decentralized as possible. But the everyday user is not going to care what technology is under the hood to an extent. They're just going to care that they get a great experience. And they can on Ethereum's Layer 2. All the liquidity is there on Ethereum. All the assets are there. The best builders in this space are looking at Layer 2s instead of looking at other chains. So I think we're going to see, as I said, I've said it so much, we're going to see more of these projects go to Layer 2 rather than trying to go to other chains. They might go to other chains as kind of like, an additional thing. They're not going to migrate from Ethereum to another chain, right? They're going to say, okay, we live on Ethereum, but we've also got an implementation on this chain and this chain and this chain, just for a market share perspective and a business perspective, where they might think, if we don't do it, someone else will do it, and they'll take our market share, sort of thing, if for some reason this other chain gains traction. And I totally understand that from a business perspective. I don't blame teams for doing that, but in terms of actually migrating off Ethereum completely, that's a death sentence, basically. Your app will die because you just do not have the network effects on these other chains yet to do that. So, doing it now means your app dies, or you have to come back to Ethereum and you've just wasted all this time. So Andre put out this really interesting tweet over the weekend. So I'll read out the tweet. So, quote, "The amount of things that start clicking together when you stop thinking about separate systems and instead systems as a whole integrating is honestly amazing. Lending is such a powerful and underutilized tool. The things we can do with it in DeFi are about to get scary," end quote. Now, he's referencing what Cream and Yearn released, and Alpha Finance released last week, called the Iron Bank. So what this is, it's basically a way for kind of protocols within DeFi to talk to each other and to whitelist each other for under-collateralized loans. So you could imagine that the cream money market trusts that Yearn is good for the money when it comes to under-collateralized loans, and will let them take out a loan with maybe even zero collateral, right? But only Yearn. It won't let anyone else do it. It only whitelists the Yearn protocol to do this. So this can be extended to any app that's on the whitelist, right? You don't have to basically trust individuals, you trust the protocol and that sort of stuff. So this is going to unlock a ton of liquidity that's typically been stuck because of the intense capital requirements for lending on Ethereum because of the over collateralization. So yeah, I think that's what he's most excited about here. And I mean, so am I, right? There's so much capital that for as efficient and like as fast moving as the capital is within DeFi and Ethereum today, it can be so much better because of the fact that there's so much quote unquote locked in DeFi that is not being used, that is just sitting there being idle capital, right? Let's use it. Let's tap into it. Let's use it in a safe way for sure. But let's get it done, right? So really looking forward to more stuff coming out about that. So Jacob Franek put out this really great chart over the weekend that shows, it's from the charts from Coinmetrics. It shows that Ethereum has been generating more cumulative daily fees since June of 2020 than Bitcoin. And you can see on the chart here, there was only a dip back, I think in November of 2020. The green line is ETH. I'll blow it up here for you. You can probably see it. The green line's ETH and the red line is BTC. And you can see, you know, I guess as DeFi summer began, you know, we had that big spike there, and we've just consistently been up here in the kind of like high fee range. So this is just saying that there is more demand to use Ethereum's block space than there is Bitcoin's. And the funny thing is that Ethereum is actually 3 to 4 times more scalable than Bitcoin in terms of transactions per second. So we're more scalable, but we're still hitting the limits of the chain and we're still generating more demand. So that in of itself is amazing. And as Jacob kind of notes here, fees for public blockchains are the most direct and hardest to manipulate measure of the value of block space. Because, you know, it obviously costs real money to manipulate. You have to pay the fees. And, you know, it reflects the user's willingness to pay for the block space, which makes Ethereum now the dominant chain, which it is. And Ethereum has flipped Bitcoin in so many other metrics at this point. It's just hilarious that the market caps are still so far away, which I think the market will actually correct in time. But yeah, I mean, this is amazing from a long-term security perspective as well. You know, it's going to be amazing with EIP 1559 when we're burning a lot of these fees. And that, you know, it actually goes to burning ETH and makes ETH maybe deflationary one day. I mean, I've spoken about this before, how this could all work, but yeah, this was a great way of visualizing that. And I mean, you can see that Ethereum is well and truly ahead of Bitcoin now. I mean, Bitcoin's trending up too because of the bull market, but Ethereum is just like way ahead. And I don't think that's going to stop anytime soon because on Bitcoin, you can only do one thing, right? You can only transfer BTC from address to address, whatever, exchange to exchange. On Ethereum, you do a million different things, right? You can transfer ETH, transfer ERC20 tokens, interact with DeFi protocols, register an ENS name, you do NFT stuff. There is so much you can do, right? Everything costs money. Everything is, you have to pay a fee to do it. And that's why Ethereum is winning, because Ethereum, you can do more, it's more expressive. And I mean, I truly believe Ethereum is the better model here. But Bitcoin, and the thing is, people might say, you know, Ethereum's different to Bitcoin, they do different things, and that's true, but Bitcoin actually relies on fee revenue for its long-term security because the Bitcoin block rewards are dwindling, right? Every 4 years they halve. And unless the price goes up to match that, then, you know, it's not going to make up for the lack of kind of actual Bitcoin block reward. So the fees are the long-term security model here, and Ethereum's already beating Bitcoin at that. So something really interesting to keep in mind, something that I watch closely. I mean, I know fees, the high fees hurt. I know they're annoying, but they are great from an ecosystem growth perspective. And as I said before, they encourage the adoption of layer 2s and all that good stuff. So yeah, go follow Jacob. Actually, he posts a lot of interesting charts because he's a co-founder of Coinmetrics. So he posts a lot of these really cool things, and he's a great follow. So definitely go check him a follow. So Tim Biker loves to drop EIP 155 knowledge randomly within threads, which is kind of funny. So basically, I discussed last week how he put out a thread saying that he doesn't think 1559 is ready to ship just yet, and he followed that up with another tweet that said he thinks it's possible that that ERP 1559 can ship within, I guess, 3 months. So, January, February, March, maybe April, May sort of thing. There's no reason to wait 6 to 12 months to ship 1559 after the next network upgrade, which is called Berlin, goes in. I mean, I speculated last week on one of the refuels that I think we can see it in July because of the fact that the difficulty bomb is going off in July. So there needs to be a hard fork anyway to delay that. So I think that we might see 1559 going then. And Tim's comment here speaks to that. 3 months from, say we don't include January, and we say, February, March, April, and then May, right? I mean, July is obviously like 5 or 6 months out, but I think, it's more likely we see it then than kind of rushed in, because we don't want to do two kind of like hard forks, right? One to ship 1559 and another one to delay the difficulty bomb. Or maybe we do one that delays the difficulty bomb and ships 1559 in May or something like that. So I don't know. I think it's coming way sooner than people think. And Tim's been dropping a lot of these hints, so he feels confident. And for those who don't know, Tim is actually the lead on 1559, the whole effort there. So he would know better than anyone. So yeah, keeping an eye on that for sure. All right, last thing I wanted to shout out here is that there's a new kind of bot here called L2 Dex Wars, which tweets out L2 Dex trading volume from the last 24 hours. I think this is going to be really great to keep an eye on. For some reason, I'm not following this account yet, because I was about to tell you to go follow this account. I don't know why I wasn't following it, because I love this account. But yeah, I mean, the volume here is funny, because there are actually accounts that tweet out about layer 1 Dex trading volume, right? And they've been tweeting out about that for years. And at the start, this was the kind of volume you would see on the layer 1 dexes. And over time, it grew and grew and grew, and we got to where we are today, where we're doing billions of dollars of volume sort of thing, right? So I think this is going to grow the same way. Once we get more layer 2s, once we get more liquidity on there, we're going to see similar volumes to layer 1. So this is really exciting, and I'm glad that this bot exists, because this is where I'm going to be watching it play out, basically. All right, everyone, that's been a very long refuel today, but as I said, lots to talk about. But yeah, thank you for watching. Give the video a thumbs up if you enjoyed it. Subscribe to the channel if you haven't yet. Join the Discord. Subscribe to the Daily Gwei Newsletter. And I'll catch you all tomorrow. Thanks, everyone.